Okay, so what exactly is Rule 7702 of the IRS code? So this rule, it regulates insurance as far as how much money you can put into it before it is taxable. So it deems if you put over a certain amount of money, and these thresholds depend on different things like age, how much you want to fund, death benefit, stuff like that. And so with that being said, it really comes back to, and I won't say funding, it's just realistically, it's a threshold they put on it before it becomes what's called let's go ahead and point it out here, a MEC. Okay, a MEC is a Modified Endowment Contract. It's still basically a life policy, but you cannot access the money without being taxable. So typically, if you take out a loan, if you do a withdrawal, they tax you on the gains first. In other products and different things where if you access the money, they'll tax you on a certain amount of basis, meaning money that you had put in. They won't tax you on that necessarily unless it's just an overall tax deferred product where you use pre-tax dollars. And so with that pre-tax dollars, which means that you didn't pay taxes on it to begin with, and it was not considered income. So later on down the line, it will be considered income and they'll tax you on it. But in this case, this is after-tax dollars unless it's purposely set up as a modified endowment contract. And then you're still regulated as a qualified plan, meaning that if you access the money before 59.5, there's potentially the 10% penalty plus any other taxes. But with that, 7702 was changed back in December. So previously what there was a 4% guarantee. So no matter what, you were getting a gross credited rate of 4% on cash value life insurance in this scenario. And so that's before any costs. But then you had a dividend. So I just put a D here. But in this scenario, for just being easy or simple, I did a dividend of 2% where it's an overall crediting rate of 6%, meaning that they will credit you that amount gross before expenses. Okay, there are some expenses for the cost of insurance. Now, with that being said, that would be 6% the way it sits. This is current. Put my little C here for current. That is what's currently in place. So what's been proposed and put into law into the rule of law, the new way. So the insurance companies have the ability to do 2 to 3.75%. And with that, let's just say that the 2% right here becomes the new guarantee. So they'll guarantee you 2% no matter what. So if for some reason the insurance company didn't turn a profit, which with the carriers that I work with, they've all turned a profit every year, and they're mutual companies, so they're owned by the actual policyholders. So whenever there's a surplus of money above what they keep for normal operating expenses and whatnot, so there's a certain amount of profit that they keep in the company, and then there's a certain amount of profit they can distribute to the shareholders, just like any other business. So if they're shareholders in the business, they get distributed the dividend, and it's considered a refund of premium of premiums paid. So it's how they basically regulate that it's not taxable as far as that gain. But if you were to withdraw the funds past what you've paid in, they could tax you if you did a withdrawal. But there's ways of getting around that and making this entire thing. The whole point of using these things is to build wealth and to not have to pay taxes on that money, especially later in life, right? Whenever you go to retire, because all your retirement funds, your 401ks, all that stuff, you still got to pay taxes on. So I know everybody loves taxes and all, but and obviously I'm kidding, but in this case, I can tell you I've seen examples where they've run illustrations on both of them at 4% and at 2% with no extra, with the dividend being declared or anything, just at those rates. The difference in the amount of death benefit that is, well, it's actually the same death benefit for the most, well, no, it's not. I'm sorry. You're actually able to put more money in. So if you were able to put in $100,000 before, you might be able to put in $150,000 to $180,000 now and still have the same death benefit. If you put in the same $100,000 though, there would be less death benefit. But with that being said, it's a less death benefit in this example, and the death benefit actually being lower causes there to be a lower expense load on the policy. So at first, the 2% looks like it's behind in the example, and when I get some more access to some of these things, because they're not actually out there yet, I'll show a comparison. But the difference in the 2% guarantee looks like it runs behind in the beginning, but after you get to say year, I can't remember what year it is, it's like 10 or 12 or something, it starts to accelerate, and by the time you get way down the line towards retirement, there's significant more money in the 2% as opposed to the 4%. And then once you add in the dividend, it made it was night and day. I mean, you may have a couple $100,000 more depending on your funding in the policy, which is a lot of money. It could, and it's all going to be to scale depending on the funding. But there again, it can be a good thing. But for most people, what they want to do and what they've been doing is they're going and they're trying to get in at the 4% guarantee, which is here. And the insurance companies in many cases, I won't say that all of them will allow this, but in many cases will allow you to reconstruct the policy to do the new guarantee, whether that's 2% or 3.5%. Sorry, it's hard to draw with a mouse. Whether it be 2% or 3.5%, it'll all depend. Like I said, there's been no particularly whole life that has actually been repriced. There's one BOLI product, which is bank-owned life insurance. They're the biggest buyers of life insurance in general. Banks, look it up, BOLI, BOLI. You'll see they have a site that, it's public info. Anyway, the second largest is business-owned life insurance. So, it's some people call it COLI or corporate-owned, but they do a lot of deferred executive compensation plans. They use it for, and those deferred executive compensation plans are basically used to help lock in an employee for a certain number of years and where they're not going to move on and leave. And you're creating this incentive, and I'll probably do a video on this later, but it's creating an incentive for them to stay for it's usually 10 years, and before they have some sort of arrangement of changing ownership, because the business will own the policy until that time, or maybe it's a later time. but the business will own the policy and then be the beneficiary also of a part of the funds to make sure they get back their funds tax-free and maybe with interest. So it just depends on how they set it up. And then the rest of the death benefit goes to their loved ones. But in that, with all the money that was paid in and the growth, it creates retirement income for this executive. And usually it's pretty substantial. There was a college coach that had this, and I can't remember. I want to say it was like Jim Harbaugh or something, but I could be wrong on that. Don't quote me on that, on the name of who it was. But they created one for this individual, and they were putting like $1 million a year in there for 10 years, and it was really substantial. But basically, it keeps them in employment there, because if they leave prior to, they lose it. So, or there's some other arrangement which puts them on the hook for some sort of not only taxes of the individual that it was for. It might put them on hook for taxes or whatever, but there is an arrangement where with the insurance companies and with the code, where if the businesses do this, that they're not necessarily taxed on it, or there's an ideology behind on how that works, that they leave prior to, or it's within like the first 5 years. But anyway, I'm getting way off track. So with that being said, you have potentially the opportunity of going into the new situation, the new policy construction, if there is, you start seeing the illustrations and seeing that this has the potential to for sure be a better way to go. And there's also ways to tweak it to where you can add on, maybe extra term insurance or something to make up the difference. And depending on your age, it won't be super expensive. It'll be relatively potentially cheap. And you'll be able to have that extra death benefit if that is of concern. But if you're just doing it for cash accumulation, which most are, then this could be a great thing. So I'll probably do some more videos on some of this later on. And for right now, I guess that's about all I got. But if there's any questions you have or anything, please put in the comments. Please like, subscribe, and click the notification bell. And I apologize for the quality of the video on this. I could not get my other camera working, so I have a webcam. And not that the point of this was actually to see me speaking on this, but or actually see my face, I should say. But other than that, everybody have a great day, and we'll catch you on the next one.